So as you can see, all right, um, the objective of, the market share factor is as well positively related to profitability, okay? Because if we are profitable, we are likely to ensure that we increase our market share, right? And that will as well ensure that we grow as an entity, we expand our operations and so forth. And if we ensure that our cash flows are stable and we are highly liquid, then we are able to pay our debts as they fall due, whether short term or long term. And then customer satisfaction, if we ensure that our customers are happy, then our business obviously is also going to increase its profitability. It is also going to increase its market share. Okay, then if the quality is increasing, is high, if our products are of high quality, then obviously we are going to have more customers who are satisfied, and that will trigger profitability and increase our market share, and we grow as an entity and our cash flow positions increase. What about industrial relations? If we are good with the regulators, with the suppliers, and we are an industrial leader, uh, obviously we are also going to increase our market share, our profitability, our growth. So you can see that the corporate objectives actually shape the way the finance director has to behave if we want to ensure that we remain profitable. Therefore, the finance manager strategies should ensure that they are in line with that vision. All right, value adding systems and so forth ensure that customers are satisfied. Okay, industrial relations are maintained, all those things. So you can see that these are the key factors for business success, which the finance manager should respect or observe. All right, now the financial objectives. Financial targets may include targets for earnings, all right, the earnings themselves, earnings or profits, all right, uh, the earnings per share, dividend per share, gearing level, profit retention, operating profitability. All of those are the targets the finance manager should seek to achieve. All right. The usual assumption in financial management, we have already spoken about this, is to maximize shareholder wealth. Right. So we are going um, to be focused on the dividend the shareholder is going to receive, right? The market value of the shares, right? Because by the end of the day, we need to ensure that the share price is not depleting but rising, right? Um, a shareholder's return on investment is obtained in the form of dividend received or capital gains. Sometimes shareholders might have a preference for receiving a dividend now rather than later. But other shareholders would say it's not worthwhile. We need to reinvest the money. So it is better to reinvest it and get capital appreciation in the form of share price increase. So other shareholders consider capital gains. Capital gains are related to the share capitalization, or the increase in share price or the market value of their shares. Right? So there are two. So this is why we say that you, as a finance manager, you need to understand the corporate or business objectives, business or commercial objectives, as well as financial objectives. And in the financial objectives, we say that there are three key. We said the investment decisions, the financing, as well as the dividend decision. All right. So you need to understand what are the preferences of your shareholders. Do they want the dividend now or they want it later? If they want it later, it means that you then have to please them in terms of share price appreciation. Otherwise, if they even if they were having a mentality of future dividend, they would be forced to demand the dividend now. And that might be having some dire consequences on the company. So you need to evaluate the available options and then you advise the shareholders accordingly. Continuing with the financial objectives. If there is an increase in earnings and dividends, management can hope for an increase in the share price too, so that the shareholders benefit from both higher revenue, that is their dividend. If they get the dividend, it means they will be having more revenue, right? And also capital gains, higher share prices. Total shareholder return is a measure which combines the increase in share price and dividends paid and can be calculated as R is equal to C plus in bracket PE minus PB over PB, where R is the total return over the period, C is the cash payment received during the period, PE is the ending price of the investment, and PB is the beginning price. An example, price of stock at the beginning of the year was $60. The dividend paid at the end of the year, $2.40. Price at the end of the year was $6.9. Calculate the return R for each of the stock. Pause the video and try to calculate it. So using these figures, using this formula, we can calculate R as C is the cash payment received during the year, which was $2.40. They received a dividend of $2.40, but we need to add the future return or future dividend, right? They can get. This could not be a dividend, but an increase in the share price, right? Because the PE is the closing price, whereas PB is the opening price. So the closing price was 69, but the beginning price was 60. All right. So we then have to divide all these by the PB, and PB was given as the beginning price of 60. So punching these figures in your calculator, you should get 19% or 0.19. 19%. However, this 19% includes both the current return, all right, as well as the future return. Now, we need to split it. So let's split it such that we have the answer is 19, okay? The answer is 19%. But let us split the current return as well as the future, or let me just say capital return, right? Because we talk of capital gains, capital appreciation. All right, so the current is the dividend now, all right? And the dividend now has been found to be $2.40, all right, over the price at the beginning, which was 60. So this should give us a 4%. So their return currently, if they get a dividend of $2.40, they are getting 4% return. All right. Now, if they wait, further, okay, or the return they get from the beginning, which was $60 in price, share price was 60, but it was now 69. So they get something like $9 over 60. This should give us something like 15%, right? So you can see that the capital return was higher, all right? And if we add the capital return, 15%, and the current return, 4%, we get 19%, which is the total shareholder return. So shareholders need to then, you know, determine over time if it is worthwhile to wait, right? To wait until we get our monies or a future dividend over, after some time. Are we having some share appreciation or not? If there is no share appreciation, then they will be forced to reclaim their dividend now or to dispose of their shares en masse, which would be catastrophic to the company. All right. So by the end of the day, if the finance manager or if the company is being managed well and the share price is increasing, and as well as the dividend is also increasing, shareholders are likely going to be very happy to remain having their investments or to increase their investments in this particular company. Are we together, ladies and gentlemen? Don't worry, we'll also cover the aspect of investments as we proceed with the module. All right, we'll cover dividend policy, we'll cover all those things within this module, so do not worry for now. Now let's talk of wealth maximization. All right, wealth maximization is not profit maximization. Please remember that. A company might be having a lot of profits, but ending up failing to sustain in the longer future. Why? Because in as much as they were making a lot of profits, they did not manage the entity in a share maximizing way. All right. So the main principle underlying wealth maximization is the cash flow. The cash flow theory. Cash flows. Sometimes you might be making a lot of profit, but not making any money. Right? Remember, profit is an accounting term. All right? Profit is subject to accounting conventions. Accountants could manipulate the cost of sales value or the depreciation values and so forth. But at the end of the day, when we arrive at the profit, you would realize that no money was actually being received by the company. Remember those aspects of revaluations. Okay, a revaluation of investment property is recognized in the profit or loss, right? But that does not mean that the entities made money, all right? It is just an assumption, an accounting assumption, all right? So you can see, as shown on the screen there, that the arguments are actually saying that making profit is not the same as making money. Wealth maximization has to do with cash flow. Cash flow. Please understand that. Okay, better. Now let's talk of earnings per share growth. Earnings per share is calculated by dividing the net profit or loss attributable to ordinary shareholders by the weighted average number of ordinary shares. Earnings per share is widely used as a measure of a company's performance and is of particular importance in comparing results over a period of several years. So we are not likely going to be happy to see a positive EPS for the current year without knowledge of the previous 5 years. So over a period of years, then we will be convinced that the company is doing or not doing well. A company must be able to sustain its earnings in order to pay dividends and reinvest in the business so as to achieve future growth. Investors also look for growth in EPS from 1 year to the next. All right. And remember, in most jurisdictions, this is actually a law. It's an aspect of law that you are not allowed to pay dividends from non-ordinary activities or from non-ordinary earnings. So you need to ensure that he has made some profit for you to pay dividend. You do not pay your dividend from sale of non-current assets. It doesn't work like that. You need to ensure that you have made profit. All right? You need to ensure that you have made profit because the earnings we are talking about, or the EPS, the earnings are earnings attributable to shareholders. They are not just earnings. These are earnings attributable to shareholders, which are after-tax earnings. They are after-tax earnings. Okay, so that's the ultimate profit, which should be then distributed to the owners of capital. All right, so we expect the EPS to grow over time. Otherwise, we won't be happy. Let's look at the example and try to work out the solution. Gareth made profits before tax in 2008 of 9,320,000. So remember, we said that the profit should be after tax for you to calculate the earnings per share. It should be after tax. So if you are given profit before tax, you need to adjust that profit to become profit after tax. The tax amount was 2,800,000. The common share capital is as follows. And so in the examination, the figures are not going to be arranged like this for you. You need to pick them from the statement of profit or loss and other comprehensive income, as well as the statement of financial position. All right? Here, we have just made it easier for you so that you understand the concept. All right, so this figure is found from the statement of profit or loss. All right, this one again can be found from the statement of profit or loss, right? And this one now is the SFP information. Okay, get that one from the statement of financial position. All right, the ordinary shares were 10 million $1 shares. All right, that gives us 10 million. Then 8% preference shares were worth 2 million. Now, when you see this type of information, what should come into mind? Automatically, you need to know that the 8% here is the preference dividend factor. preference dividend factor or index, okay? Or let me just say the interest of the on the dividend, all right? Right? So how the dividend is going to be computed. So in this case, if the value, okay, the ordinary value, what can I say? The nominal value actually. If the nominal value of the preference shares is 2 million, therefore the dividend should be 8% multiplied by 2 million. All right. So if you and the reason why we need that dividend is because for us to arrive at the earnings, they should also be after dividend. Remember, after preference what? Dividend. Because the shareholders, the EPS is for the ordinary shareholders. Those shareholders are going to be paid after we paid all other creditors. All right? So preference shareholders are actually a liability to the business. They are paid before ordinary shareholders. So when we calculate the EPS, we should also take into consideration first the preference dividend. So you need to calculate that. Please don't enter into the ACCA financial management examination without knowing those basics. Otherwise, you come out with injuries, with scars, which cannot be healed. Are we together? Thank you. Now, what is 8% of 2 million? This should be 160,000. All right, so that's the dividend. Now, you now have these figures at your fingertips. Now, let's compute the earnings per share. It's interesting, isn't it? Thank you. Now, the profit, okay, let me just put my dollar sign there. And we start with the profit before tax. This one was given as 9,320,000 in the question. This was given, please. I don't want you guys to be lost, all right? Then we were also told that the tax was 2.8. So let us do away with the tax. Tax 2.8 million. So we need to move the tax and we get the profit after tax. This should be 6520. All right. You just have to, you can pause the video and do the computation on your own, right? Or just have to verify the figures because I'll be using my head to compute this, so you need to verify. But what is very important is not to get the correct figures there as I present them, but to understand the concept. I once heard you guys commenting that no, the English is poor, so we can't follow your video. Remember, this is a professional examination. Your English grammar is not that very important. This is an international examination. It's not an English examination, all right? So they will be testing, all right? They will be testing your ability to articulate the business ideas, the financial acumen, all right? So grammar is something else, all right? While it might assist you to get good marks, it is not going to assist you to get the ideas. Get the ideas now so that you'll be able to pass the examination. Are we together, ladies and gentlemen? Thank you. So let's proceed. We then have to consider other deductibles. In this case, let us deduct the preference dividend. The dividend. Okay, we have done this one in our working and we obtained that it was 160,000. Right? So we then get what are called earnings attributable to shareholders. Okay, and when you talk of these shareholders, these are ordinary shareholders. And if you write attributable to ordinary shareholders, the examiner is going to be very happy. Why? Because you've shown that you are now mature and you are understanding what is going on. All right, so the earnings attributable to ordinary shareholders, and how much are they? These are now 6.360, right? All right, and then we double underline. Then we ask ourselves, for us to compute the earnings per share, what was the formula? The formula was saying EPS is equal to the earnings attributable to shareholders, divided by the number of ordinary shares. Okay, the number of ordinary shares. Right? So you ask yourselves, I now have the earnings attributable to shareholders. What is the number of ordinary shares? And we've been told that they were 10 million, right? That's the number of shares. So we come here and say, 10 million, where are you? And the 10 million says, no, I'm here, just slot me in. So we have slotted in the 10 million. So we then go back to our calculator and do the punching. So you will see that if we put your 6.3 million and 60,000 there over 10 million, don't mind the writing, you're going to get an EPS of 63.60. Okay, then I want you guys to tell me 6 million over 10 million. What did you get? Obviously, you got an answer with a 0.6360, something like that. Okay, that's what you got. All right, but it is industrial standard that the EPS is presented in cents. Are we together? So the 63.60 I have put there is just the same as this one, but the industrial standard is that we need to put this in cents. So that's 63.60 cents. So in an examination, remember these are computer-based examination. If you put your 63.60, your 0.6360 what, you're going to get a 0. Why? Because they expect that you understand financial theory. Okay, you need to understand what is happening as a finance manager. You need to understand what is going on. So you have to say 63.60 cents. That's the industrial norm. You need to check the published financial statements of these listed companies. When they print the earnings per share, it is put in cents. Are we together, ladies and gentlemen? Thank you. You are my students, and I love you guys. I love you guys. Right? So please do the right thing. Hey, hi, Raphael. Good. And Annie, I hope you're understanding. I hope you're paying very, very careful attention. Thank you. Let's proceed. Now, this is another example because if I do not give you examples, you guys, you are not going to master these things. All right. Benya made earnings attributable to shareholders of 8.250 thousand in 2008 and 8.880 thousand in 2009. The company's share capital was 12 million ordinary shares of $1 each in both years. So the share capital did not change. Only what changed was the earnings attributable to shareholders. And when I say shareholders, I'm referring to ordinary shareholders. Ordinary shareholders. Are we together? Thank you. So the question is saying calculate the EPS for 2008-2009 and EPS growth in relative and absolute terms. What do we mean by relative? Relative simply means that we are talking of percentile or percentages or average. Okay, so in percentages, we are not exactly demanding the actual monetary growth, but we are looking at the relative or the proportional growth. The proportional growth. So we want you to give us percentages. There is more value in giving us the averages or the proportions. Why? Because there is more understanding of the information or more value addition of the information rather than giving us just simple figures. Are we together? Then absolute terms, these are actual figures, actual monetary figures. Monetary figure, okay, the actual amounts. So it is more arithmetic. It's an arithmetic growth, right? It's more arithmetic growth. All right, so let's tabulate and show you what we mean. All right, just the background only, and what's important is that you need to understand what will be going on. So the first thing is that we need to compute the earnings per share in each year. So let's start with the 2008 EPS. So we start with the earnings attributable to shareholders. This was given as 8,250,000. These were dollars. All right, and the number of shares, we were told that there were 12 million. So if we divide these two figures, we get an EPS of 68.8 cents. Please practice these things. Then we come to 2009. We put our dollar sign, and what was the earnings attributable to shareholders, the EATs. Okay, the earnings attributable to shareholders in 2009 were 8.880,000, and then the number of shares were still 12 million. Okay, we divide there, we put our divide sign. The EPS is now going to be 74.0 cents. Okay, so obviously there has been some growth. All right, so growth in absolute terms. Let's start with the absolute growth. Absolute growth. We say that this one is more arithmetic. Arithmetic is just addition and subtraction, isn't it? So arithmetic growth here is that we have moved from 68.8 to 74. So we simply say 74.0 minus 68.8, and we get the growth of how much? This is 5.2 cents. Just put a C, 5.2 cents. Okay, 5.2 cents. That was the growth, isn't it? Good, the absolute growth. But tell me, if you just, give that information, the 5.2 cents growth to to a non-finance manager, obviously they won't understand better. So you also need to give out the relative information. So the relative growth, relative growth in EPS. All right. The relative growth in EPS takes into account the computation that has been made by the arithmetic growth. So in terms of the arithmetic, we had found that we had increased by 5.2 cents. However, we then have to say we have increased from where? From 68.8 cents. Okay, the 68.8 cents was the 2008 EPS. All right, so this should give us an increase of 7.6%. This is more informative. Okay, the shareholders would easily understand that, oh, we are moving, but we've moved this much. So the 5.2 cents is making sense now. Why? Because we now know that it is a 7.6 increase in earnings per share. Are we together, ladies and gentlemen? All right. So what it means is that the relative growth actually is a computation of the capital gains. When we were talking of the shareholder return, the total shareholder return. So it's just an issue of saying currently the EPS is at 74.0 cents from 68.8. All right. All divided by 68.8. Sorry, 68.8. Okay, so that comes to 5.2 cents over 68.8 cents, and we get your the 7.6%. Right? Is that clear, ladies and gentlemen? Great. All right. So I think those ones are not things we have to worry about much. You can just read through. Now, I think as a finance manager, we also have to worry about stakeholder management. All right, because it's something that is very, very essential in our handling of the organization's finances. All right. What are stakeholders? Stakeholders are individuals or groups who are affected by the activities of the firm or who have interest in them. They can be classified as internal, that is, employees and managers, connected, that is, shareholders, customers, and suppliers, and external, that is, local communities, pressure groups, and the government. So, as you can see here, we have got three categories of stakeholders which are examinable at this level. All right. So when we talk of internal stakeholders, we are referring to the current employees as well as the ex-employees who are now pensioners, the managers. All right. Not really an ex-employee who is no longer who is not a pensioner cannot be necessarily considered an internal stakeholder. But a pensioner now, usually these pensioners might be entitled to certain payments from our company, something like that. So they still have some bearing. Okay, they still have to be considered as internal because they are still attached to us. All right, the managers of the company, the directors, all these are internal stakeholders. Then connected stakeholders, these ones are connected to the company, but they are not necessarily internal. All right, so the shareholders, please do not. Usually, students confuse shareholders as internal stakeholders. They are not internal, although they are directly linked to the company, but they are not internal. They are actually connected, right? They are connected stakeholders, debt holders, customers, vendors, suppliers, competitors. All these are connected. Then, when we talk of external stakeholders, we are referring to the government, pressure groups, local and national communities, professional and regulatory bodies. Now, stakeholder groups, strategy and objectives. The actions of stakeholder groups in pursuit of their various goals can exert influence on strategy and objectives. So, which means we need to put those stakeholders in mind whenever we are crafting some strategy and objectives. The greater the power of the stakeholder, the greater their influence will be. Each stakeholder group will have different expectations about what it wants, and the expectations of the various groups may conflict. You may as well revisit the Mendeley matrix, Mendeley power interest matrix. We did this one in our paper, Business Technology or Accountant in Business. That's when we covered this aspect, but you may as well revisit it for you to understand the theoretical underpinnings related to this particular subject area. Each stakeholder group will have different expectations about what it wants, and the expectations of the various groups may conflict. Each group, however, will influence strategic decision making. So, how do we then encourage a convergence of interests to ensure that the corporate objectives do not suffer? How do we ensure that the interests of the managers are in line with the expectations of the shareholders? How do we make that? Organizations can align their activities with stakeholder objectives through various mechanisms. Two key approaches include managerial reward schemes and regulatory requirements. Here's how these can work. Managerial reward schemes, that is share options and performance-related pay. A. Aligning interests. Share options and performance-related pay align the interests of managers with those of shareholders. Managers are incentivized to focus on activities that enhance shareholder value, such as profitability and share price growth. So with a share option, obviously managers are going to be happy, and because if we are saying that if you achieve a profit of, let's say, 5 billion, you are going to get 500 shares each one of the board of directors are going to get 500 shares. Then obviously, if it is in a company that is making money, or that is having its share price increasing year after year, then managers are going to be incentivized, are going to be motivated to stay with the company, to do everything possible that is going to bring positive results on the table. Motivating high performance. Performance-related pay tied to measurable targets like revenue growth, cost efficiency, or customer satisfaction motivates managers to exceed expectations. So, on aligning interests, the main point we can highlight there is that if the managers are happy, obviously they are going to do things which are favorable to the shareholders. So that's aligning interest. And then when we motivate, a high performance, we are simply saying that such rewards are likely to engender a sense of employee engagement. Okay, employee engagement, right? Or employee civility, something like that. Something that, or let me just say employee citizenship, where the employees or the managers themselves are going to act in the interests of the shareholders. Then the long-term perspective is a situation where we are saying the share options, because we are saying we have already said that there is a benefit in capital appreciation or capital return. If you have got shares in a company that has got a history of increasing share price, then you are forced to stay with the company on the hope that when you leave, the share price would be much, much higher. So whatever you are going to do is not going to be something that is uh, short-term forecast, but something that is long-term forecast, something that is going to be sustainable to the organization. Then risk management. Properly designed schemes balance short-term rewards with penalties or deferred payments for unethical or overly risky behavior, protecting stakeholder interests. So you can see that there is also a risk management benefit in a way that there would be some conditions assigned or tied with the vesting of share options, right? So managers are then forced to toe the line. They will be doing actions which are not going to, restrict them or limiting them to access the maturity of the share options. All right. So they would be abiding with the terms and conditions such that in the end, they would also be acting in a positive way. So risk management attribute is a very important factor there. Then regulatory requirements as a way of encouraging the achievement of stakeholder objectives. When we are looking at regulatory requirements, we are looking at two things: the corporate governance codes and listing regulations. Listing regulations are related to the stock exchange. Like, for example, the Zimbabwe Stock Exchange or the Victoria Stock Exchange listing rules. All right, so let's start with the corporate governance codes of best practice. These ones bring three key variables: transparency. These mandate disclosure of key decisions, financial performance, and risks to ensure stakeholders are well informed. Okay, so if there is now transparency embedded in an energy systems, therefore stakeholders, like for example potential shareholders, they are going to ensure that their interests will be covered as well. They will be informed before they make any investment decision into the company. They would, they will be having much of the information. Actually, what is being tabled here is that information asymmetry is reduced. There will be more information into the market when there is an adoption of best practice corporate governance. Accountability. This one requires boards to include independent non-executive directors who act as watchdogs for stakeholder interests. So we won't be having an executive board that is dominating without being challenged in terms of strategy. So when we involve non-executive directors, then it means that we are going to have a balanced board, something that takes care of the interests of stakeholders. Lastly, fair practices. These ones promote equitable treatment of all stakeholders, including minority shareholders. So this list is not exhaustive, right? If you review best practice corporate governance codes, like for example the ZIM code, okay, the ZIM code or the UK code actually. If you refer to the UK corporate governance codes, you can then see that the principles of fairness, of accountability, of transparency, they are well articulated. So you need to have, to expand your reading interest into those areas as well. Lastly, let's talk of stock exchange listing regulations and how they encourage the achievement of stakeholder objectives. Because this is an examinable area, and many students struggle here because they fail to link these aspects with the questions. The examiner here is interested in you telling him how stakeholder interests or objectives are, are managed or are achieved. What are the mechanisms available? So you should be able to articulate mechanisms related to managerial reward schemes, mechanisms related to the regulatory environment, the regulatory requirements. Otherwise, if you just get into the exam hall and started to wobble or to just, talk nonsense, you're going to fail. Are we together, ladies and gentlemen? So let's talk now of the stock exchange listing regulations. Here we are looking at three things: compliance obligations, investor confidence, penalties for non-compliance. Compliance obligations. These require companies to adhere to standards such as regular financial reporting, fair disclosure of information, and meeting capital adequacy requirements. So the stock exchange would require companies to produce annual reports, for example, or to disclose certain information. If you do not disclose that information, you're going to be delisted or suspended by the stock exchange. Or if you fail to meet certain capital requirements, you are going to be suspended or delisted. If you check on the Zimbabwe Stock Exchange, for example, there are companies which have been suspended for failing to meet stock exchange listing regulation. It's a very serious issue, and you need then to point out that these regulations assist in ensuring that stakeholders are well informed, are protected, their interests are protected. Investor confidence. The listing regulations enforce mechanisms to protect investor rights, ensuring stakeholder trust the organization. Okay, so if a company is listed on the Zimbabwe Stock Exchange, for example, there is a high chance that it might attract foreign investors, even local investors. Why? Because there is more confidence in dealing with such a company because it is required to follow a lot of rules which will limit management to behave in an uncut way or in an unbecoming manner. So this is why listed companies always find investors. Why? Because the investment there is considered less risk other than just to invest in a museum business, which is not listed. All right, because it is not bound by enforceable rules. Lastly, penalties for non-compliance. Companies face fines, delisting, or reputational damage if they fail to comply, motivating adherence to stakeholder-centric policies. So by the end of the day, if a company is a listed company, there is much reason for it to follow the rules. Otherwise, it is going to be penalized heavily or to be delisted, or but in the longer term, to have its reputation put at stake. So you can see that there is more benefit to the company to follow the rules rather than to abscond them or to flout them. All right. Now let's talk of this animal called working capital management. So I think we need to dedicate a separate video on this one. Okay. So, ladies and gentlemen, thank you. See you in the working capital management video.